We could see gold rally to about 8,000. If gold was to get traction here and not break the low around 4100, we should see gold go to about 8,000. What happens if it breaks down? It's going to go one of either ways. And gold is pointing to the 100% measured move, which is about $3,500 in gold. We're seeing gold move pretty much with equities. If there's a big down day in stocks, gold goes down. If there's a big rally in stocks, gold goes up. If gold comes down here, though, it also means the stock market has most likely topped. It means the economy has got bad news. There's going to be a lot of blood in the streets. When we look at silver here, silver could still have a very big correction to the downside. Just based on the sell-off, this bounce here, it is still showing that silver could come down to around $40 an ounce. There is the bullish case that if precious metals get traction and more chaos hits, based on the full rally and the pullback that we've seen so far, it actually points to the upside for silver being around like 172. Depending on the low that we use, it could also be, about the 155 mark.
It's been an interesting year for gold. We had a big momentum trade at the beginning of the year, then gold sold off as this conflict escalated, leaving many people a bit puzzled by that move. Gold, I think, is up for the day today, but what's your outlook on gold?
Yeah, so I have the same outlook for gold, silver, and miners. Just the charts have different percentages. We've seen gold over the last several years doing what it does. Increased negative news. People don't trust the data anymore. We got wars going on. I mean, gold was doing its thing, just moving up and to the right. This year, actually late last year into this year, we really started to see that feeding frenzy, that euphoric phase of people piling into precious metals, they had to get in. If they weren't in, they got in because they felt like they were getting left behind. So we saw this huge move, and now we've got this huge sharp correction. And this big correction really, I think really punched a lot of investors in the face. It really shocked them. And now they don't know really what to do. And we're seeing gold move pretty much with equities. If there's a big down day in stocks, gold goes down. If there's a big rally in stocks, gold goes up. If there's bad news in the economy, gold drops. If there's good news like today in the economy, gold rallies. It's not doing what it normally does. And that's because we just saw this massive wave of selling, multiple waves of selling through gold. It has shaken things up. And now investors, I think they're really just kind of stunned trying to figure it out.
Gold is starting to behave less like a safe haven and more like a crowded trade that suddenly lost its script. As Chris Vermeulen points out here, the sharp reversal after a euphoric run exposed how quickly emotional money can distort a market that investors usually treat as protection. Instead of rising on fear, gold has recently mirrored equity swings, which suggests institutional positioning may now be driving short-term moves more than macro headlines. That kind of correlation often appears when conviction weakens beneath the surface. Next, Chris Vermeulen discusses why that unusual behavior could be the warning many investors still are not recognizing.
When we look at gold, there's a couple interesting, there's two scenarios. It's either going to continue to go higher. So it's got this giant, what is called a bull flag chart pattern, and price could oscillate through here, or it could even start to build more of a launch pad and build a series of breakout points. And we could see gold rally to about 8,000. If gold was to get traction here and not break the low around 4100, we should see gold go to about 8,000. But right now it's in what I consider just a neutral territory. Let it do its thing. It could trade sideways. It could trade lower for a long time. But once it starts to turn up and gives us a new buy signal, you got to get in, because the next move is going to be about to $8,000 an ounce. Now, the flip side of that is what happens if it breaks down. It's going to go one of either ways. You need a strategy for both. If we use Fibonacci extension, which is a very accurate tool, especially for gold, I find it works very well. This tells us, based on this last sell-off and this bounce, where gold should go. And gold is pointing to the 100% measured move, which is about $3,500 in gold. That 3,500 mark is the breakout zone for where everybody started to go in that euphoric phase. And that euphoric phase is that last push. I showed this on the chart here. It's this last big pop and push. Everybody gets in, and then it corrects really sharply, typically goes into a bear market after that. So when we look at this, it is telling us, the chart's already telling us that gold naturally wants to come down to this level. And the market is very efficient, meaning anybody who was late to buying gold, who bought in on this emotional wave, they bought because of emotion and pain of missing out. Usually the market has to come back and put them under serious pressure and try to get them out. They buy high, they sell low, and then of course the market can take off without them after that. And so, that's kind of that opportunity for gold. If we take a look at silver, which is a similar chart, except for it's much more volatile. It has done the same thing.
Before we get into silver, if I can cut you off there, Chris, because I do want to focus on gold a little bit more, and then we'll tackle
Sure.
silver. So are you saying that you're seeing 3,500 as a support level there? Is that the level that you think is the ultimate support level in both of these potential moves?
I think 3,500 is going to be 3,500 is going to be a critical support level. If it gets down there, that to me is going to be a point. Hey, if you're a long-term investor and you want to buy on like a cycle low after a big correction, that will be the point.
The real issue here is not whether gold reaches 8,000, but whether investors can survive the path it takes to get there. As Chris Vermeulen points out here, the same chart allows for a breakout toward 8,000 or a washout back near 3,500. Which means discipline matters more than optimism. Markets often revisit the exact zone where late buyers rushed in, because emotional entries usually get tested before a larger move begins. That is why neutral price action can sometimes carry more meaning than a dramatic headline. Next, Chris Vermeulen unravels why a deeper pullback could actually create a stronger long-term setup.
I think any precious metal trader, to be honest, should be excited to see gold break down and come down to this level, because if you are a true gold bug, then you want gold to go higher over the long run. But why wouldn't you want to pick up a bunch more at this kind of important pivot low? Because this pivot low sets us up for the next huge leg that's going to last many years again. And so I really like this. I'm a bit more active trader when it comes to precious metals. Like I play the super cycles in gold. So if I was to just zoom way back in gold here, the play that I do here is in 2019, gold broke out of this base. This was a stage one base. A stage one base is a major bottom, which if we go and we look at this graphic that explains the stages, a stage one is a base just before you go into a huge rally. And then you got your euphoric move. So when we look at gold, this is where I got in. We added on the COVID crash. And we actually sold gold just above 5,000, and we sold gold at 113. So we're on the sidelines. And so in a perfect world, everybody should almost kind of want gold to pull back to this level.
Most investors say they want lower entry prices, but very few stay calm when those prices actually arrive. As Chris Vermeulen points out here, a pullback into a major pivot zone could become the foundation for the next multi-year move rather than a reason to panic. Gold's 2019 breakout showed how patient capital can benefit when markets emerge from long accumulation phases instead of chasing the final euphoric surge. The challenge is that fear usually feels strongest right before value quietly starts returning. Next, Chris Vermeulen talks about why that opportunity could arrive alongside serious stress across the broader.
If gold comes down here, though, it also means the stock market has most likely topped. Probably means the economy has got bad news. There's going to be a lot of blood in the streets. But when gold gets down to this support level, I think that's where you can start backing the truck up and saying, okay, I'm going to buy here. And then potentially you could buy some here. And when it builds a bottom and a base and starts to move up, you can buy the breakout like in 2019 and load up the rest for the next leg higher. So this is a huge opportunity, but it means we're also going to see a lot of pain across the world and in businesses, and unemployment rates are going to skyrocket and all of that stuff. So this is a great opportunity, but we just have to let the markets figure out if they're going to go down to that level or if they're going to just start to rip higher and head to 8,000 now.
Right. So that's the question, because I get that obviously long-term you're very bullish on gold, but in terms of direction, does it go up now? Does it go down now? What is the signal that you're looking for to confirm the move, either upwards, continuing that trajectory to 8,000, or perhaps going down to that 3,500 support level and then continuing upwards?
The uncomfortable part of this outlook is that a better gold entry may come from a worse economic backdrop. As Chris Vermeulen points out here, a drop toward major support could coincide with rising unemployment, weaker equities, and the kind of broad fear investors usually underestimate until it is already unfolding. That matters because gold does not move in isolation when liquidity tightens across the system. Sometimes the best long-term setup arrives wrapped inside the headlines most people are trying to avoid. Next, Chris Vermeulen discusses the signals he watches before committing to either direction.
What's the signal that you look for now to determine the near-term direction?
Yeah, there'll be several things that build the picture, right? It's not just price. There'll be sentiment. There'll be money flows. There'll be all kinds of different things happening. But, in order for price to firm up, price needs to start to build some type of series of higher lows and higher highs, like a bull flag pattern. So a bull flag pattern means you have a rally and then it flags, and then it rallies and then it flags. And a bull flag is usually a halfway point. So whatever this rally was up to the top, that same rally after it flags should rally the same distance. And so it can stair step its way up. We eventually want to see gold put in some type of rounding formation or trade sideways long enough that when it starts to break out, we can buy a breakout from a previous high. And so that's what we want to look from a price standpoint. But right now we're not seeing that. So gold needs a lot more time. It needs a lot more price bars to draw us a picture that says, based on these charts, these bars, it's telling us that, hey, people are bullish, people are accumulating it. We're going to want to see, the sentiment of the market probably becoming nervous again and gold doing its thing. Like, we want to see gold moving up when the stock market starts to struggle a bit. We want to see gold moving up when there's some bad news and bad economic data, but right now it's not. So right now we are completely neutral. We don't own or touch gold or silver right now. We have to let it probably put in several more weeks, potentially several months, before it gives us a chart pattern that we say, okay, this is actually the start of a new trend. Let's jump in and play that. So it's just time, right? It's not about always being in a trade. The most successful traders are patient. You let the charts play out and take advantage of the legs. Like, as our more aggressive strategies, we played this breakout in gold here for just a side trade. On top of our positions we already had, we did a quick ETF trade. We did another one right here to catch this euphoric move. There's very clean signals when you understand how to read the chart, the money flow, the sentiment, that we can take advantage of these. Get in, get out, wait for the next setup. But people like to always hold through chaos. And
the market often punishes investors who mistake movement for confirmation. As Chris Vermeulen points out here, price alone is not enough because sentiment, money flow, and broader market behavior must align before a real trend deserves trust. Gold failing to rise on weak economic data is a subtle warning that institutions may still be distributing into strength rather than building fresh positions. Many investors lose money because they force trades during neutral conditions instead of waiting for evidence. Next, Chris Vermeulen discusses why patience can protect capital better than reacting to every short-term move.
I don't want to do that because potentially this market could sell off, come down to 3,400, and it might not come back. Believe it or not, the same chart pattern we're seeing in gold and silver right now is the exact same chart pattern we saw in 2011. And it took 14 years to break the all-time highs after that. And of course, in 2011, nobody thought gold was going down. And that's what everybody thinks right now. So that's what I want to avoid. We don't want to hold gold if it does that. We want to be invested in something else and wait to benefit from a new trend in the precious metal space.
Right. I mean, again, it depends on your trading strategies, whether you're in and out of positions, if you're just buying and holding. But you mentioned you do see gold and you gave the $8,000 number. And that's interesting because that's the exact number that Wells Fargo has come out with recently. They're saying that they think the debasement trade could drive gold to 8,000 by 2027. What's your timeline for 8,000? Does that ring true with how you're seeing things?
History tends to repeat most clearly when investors believe this time is different. As Chris Vermeulen points out here, the current pattern resembles 2011, when gold spent 14 years recovering after sentiment had become almost universally bullish. That matters because long-term conviction can still become expensive if capital stays trapped in a dead market, while other sectors move ahead. Even major bank targets like 8,000 by 2027 can distract investors from the cost of waiting through a deep correction. Next, Chris Vermeulen talks about why that 8,000 target may still be realistic despite the risk first.
Yeah, I mean, if this chart pattern is to continue to play out 2027, I think that is possible. So what I just did, I just grabbed the Fibonacci extension tool. This is telling us based on this run up, the strength of this correction. If gold is to find traction here and keep going higher, I mean, we're going to see, we're going to see gold go all the way up to about 8,000. That's the next target. And obviously gold is picking up speed, right? It's went flat for a while. It started to pick up speed. It's starting to go parabolic. If it was to kind of continue through this trajectory overall, I mean, we'd be looking into, it will probably take more time, but into 2027, $8,000 could completely be reached. I think it could actually happen this year if the market really is going to set up for one more final parabolic takeoff. It could happen this year or next year for sure. So there is that upside. I mean, I'm very excited about it. This is a giant bull flag that if gold starts to build a launch pad here and starts to break out, I mean, you gotta get back in.
Price targets can sound bold, but the bigger story is what kind of market would be required to justify them. As Chris Vermeulen points out here, the 8,000 projection depends on gold maintaining a rare parabolic structure that usually appears when confidence in paper assets starts to weaken fast. That kind of acceleration rarely happens in a stable environment because it often reflects fear moving faster than policymakers can respond. Investors should watch the setup, not just the headline number. Next, Chris Vermeulen unravels why silver may be sending an even more volatile signal than gold.
You got to own metals and take advantage of that run because it's going to be explosive. So that's how I come to 8,000 for gold.
Well, I know you got out at 5,000 and now you're sitting and waiting to see what happens. Let's talk silver. I believe you exited silver at around 113, but you warned that it could fall dramatically. You were correct on that. So what's your silver outlook now?
Yeah, so silver's doing pretty much what I was expecting. We went into this euphoric parabolic move. I mean, the best view I like to always look at is just people need to just go back and just look at the really long-term picture of what silver does or what anything does when it goes parabolic. Anyone can look at these and be like, what happens after something goes up hundreds of percent straight up, right? It usually comes straight back down. And so that's kind of what we were doing. I was at the VRIC show back when it was hitting these levels. And I said, if it breaks 106, we're going to have a very sharp explosive pop even higher. And you got to get out because that'll be like one of the final waves.
Silver often attracts the most attention right before it becomes the most dangerous. As Chris Vermeulen points out here, parabolic moves can feel convincing in real time, but they frequently end with a reversal just as retail investors finally believe the story. The move above 106 was not simply bullish momentum, because extreme upside can also signal exhaustion when speculative money rushes in too late. That is why disciplined exits matter more than emotional conviction during commodity surges. Next, Chris Vermeulen discusses how deep silver could retrace before the next meaningful opportunity appears.
And so when we look at silver here, based on this chart pattern, silver could still have a very big correction to the downside, just based on the sell-off and this bounce here. It is still showing that silver could come down to around $40 an ounce. So just like gold going down to 35 or so, silver could go down to 40. Now, on the flip side of that, there is the bullish case that if precious metals get traction and more chaos hits, we can actually get an idea of where we could see silver go, which was based on the full rally and the pullback that we've seen so far. It actually points to the upside for silver being around like 172, depending on the low that we use. It could also be, about the 155 mark, depending kind of, or 165, somewhere in this range. So there's a lot of upside potential for silver. And what I like to focus on is trying to make sure that we're not holding it through a big drawdown. I mean, we saw silver fall about like 50% a huge correction already, but it could still have a much bigger haircut from where it is now.
The most dangerous setups are often the ones that offer the biggest upside and the deepest downside at the same time. As Chris Vermeulen points out here, silver could still slide toward 40, even while longer-term projections stretch toward 155 or higher, which creates a wide risk range many investors underestimate. After already falling nearly 50%, silver remains vulnerable because volatile assets often overshoot in both directions before stabilizing. That makes position sizing just as important as conviction in this kind of market. Next, Chris Vermeulen discusses why staying neutral can sometimes be the smartest move before silver chooses a direction.
We could see another, massive drop. So these are the two scenarios. Right now, precious metals, we're neutral. They're both locked and loaded, ready to pop or ready to drop. And we don't want to just go into it and hope and pray it goes in the way we want. That's not the way I work. I like to explain it's like if you were to go to another country, you have no idea what the signs say because you can't read them. You go to a train station, it's stopped there, or a subway, and you don't know which way it's going. That's where the market is right now. The train is at the station. You have no idea if it's going left or right. And whoever kind of jumps on it, I think at this point, you're just lucky if it goes in the direction you want. So I want the train to start moving, and then I run and I jump on it and be like, all right, here we go. Because once it starts moving, these moves are huge. It should give you like imminent return.
Waiting can feel uncomfortable, but impatience usually costs more than missed opportunity. As Chris Vermeulen points out here, both gold and silver are sitting in a zone where conviction without confirmation becomes little more than speculation. Markets often look most tempting when direction is least clear, and that is where retail investors tend to confuse hope with strategy. Strong trends usually reveal themselves quickly once money flow becomes decisive, which means chasing early often adds unnecessary risk. Next, Chris Vermeulen talks about how fast the move should become visible once the metals finally choose a path.
It should be running. You should be in the money pretty much within the first couple of days or the first couple of weeks, and then it just shoots off to those next targets. So that's where gold and silver are. They're just at the train station. We just need to see which way they're going, and then take action from there.
All right, but just to sort of talk about the potential direction of this train, throw out some other forecasts at you. JP Morgan, UBS, they're calling for a new floor in the mid-80s. Bank of America is warning of a ratio compression, saying that silver is still way too cheap relative to gold. They see a bull case moonshot potentially touching 135 and then all the way up to 309. Do you have a top target here?
At this point, my top target will be, probably around that 166, 175 area.
Big bank targets can sound reassuring, but they often arrive after the market has already changed. As Chris Vermeulen points out here, the first sign of a real silver breakout should be immediate strength within days, not months of uncertain drifting. Forecasts from JP Morgan, UBS, and Bank of America may frame silver as undervalued, yet institutional calls can sometimes reflect sentiment more than timing. For ordinary investors, the speed of the move may matter more than the target itself. Next, Chris Vermeulen discusses why silver can push beyond even disciplined targets once emotion takes control.
But silver has, like you say, a moonshot. So that's what silver does. So we can give it upside targets. I initially had $80, $82, $83 target for silver. It got up to that level, and then we recalibrated the charts. We were able to redraw the lines, and then we got our new targets, up into that 106 level. So what silver can do is I could give it a target of 165 or 175, but silver typically gets emotional and it just blows past those. So that's where I think it's going to go. If it does get to those levels, we're going to see probably the exact same thing where it could just have a moonshot and just blow right past that and just keep on going. That's what a euphoric move. That's a bubble. That's what happens, right? They're unpredictable. I can usually give an idea of like, this is where it's naturally going to want to run out of steam. But when it's something that's an emotional metal like silver, where people really flock and chase prices, it can just blow right past that. So I always go with, here are my targets. And then as we get closer, we can get a feel for the momentum. We can get a feel for the sentiment. We'll be like, okay, here's our target, but at this rate, it's going to blow right on past it. And we can kind of adjust from there and say, okay, let's not get out here. Let's wait for it to blow past. Let's see a little bit of exhaustion, and then let's like start to exit. So that's what silver does. Silver could skyrocket, up into those levels. I think it's someday they will be. I just don't know if it'll happen, this year or so.
The hardest part of trading silver is that logic can disappear just when price looks most convincing. As Chris Vermeulen points out here, silver has a history of overshooting measured targets because emotional buying can push the metal far beyond where technical models say momentum should fade. That creates a trap where greed keeps investors holding after the rational exit has already passed. In markets like this, discipline has to stay stronger than excitement because bubbles rarely announce their ending.